All right, so we're ready to kick off another deep dive, and this time we're tackling a true classic, How to Make Money in Stocks by William O'Neill.
Yeah, a must read for any serious investor.
Absolutely.
Mhm.
And what I love about O'Neill is he's not just some, armchair theorist.
Oh,
The
yeah.
guy founded Investors Business Daily. He lived and breathed this stuff.
Exactly. He was out there in the trenches.
Yeah, so today we're going to extract that practical wisdom. We're going to look at the strategies you can actually put to use to improve your stock picking. Sound good?
Let's do it.
All right. So one of the first things O'Neill hammers home is the importance of chart reading. It's like learning this secret language of the market, wouldn't you say?
Absolutely. Charts tell a story. It's amazing how many, universities and stuff completely skip over this.
Oh yeah.
Charts are visual representations of supply and demand. And to ignore them is like, well, you're walking into a movie halfway through. You're missing crucial parts of the plot.
Okay, so no more skipping to the good part.
Mm-hmm.
But it's not just about staring at these lines, right? I mean, we need to be able to spot those buy signals, those clues that a stock is ready to take off.
Right.
O'Neill talks about this classic example with Microsoft back in the day, breaking out at 31.5.
Yeah, I remember that one.
What happened there?
I mean, that was textbook. You saw volume going through the roof, like 545% above the average.
Wow.
That tells you the big institutions are piling in.
They're seeing something.
They're convinced this thing's going places. And what followed was a 13-year bull run.
Okay, you've officially converted me to a chart believer. But, great stocks, they're not just about fancy lines on a graph, right?
Yeah.
We got to look at the underlying earnings of the company. And O'Neill is a big believer in that, too.
Oh, huge. Both quarterly and annual earnings increases, those are non-negotiable.
Yeah.
But it's more than just the numbers themselves. You have to dig a little deeper. Imagine, for example, a company that, sells off a bunch of assets to artificially boost their earnings for that quarter.
Okay.
Looks good on paper, right?
Yeah.
But is it sustainable? No way.
So we need to be able to see through these sort of gimmicks and find those companies with genuine growth potential.
Right.
How do we spot that?
Well, he uses this really interesting scale. He calls it a stability factor from 1 to 99
Okay.
to measure earnings stability.
Okay.
Think of it like a roller coaster. You want the smooth, steady climb. You don't want the one that's jerking you around every 2 seconds.
So we're not just looking for fast growth. We're looking for consistent, predictable growth.
Absolutely. Older companies especially can get tempted to kind of inflate their numbers.
Right.
Truly innovative companies, their results speak for themselves.
So a high growth company could potentially be more risky than one that's slower and steadier.
Potentially, yeah. Think back to like Home Depot and Microsoft in the 80s. New, entrepreneurial, fresh. And the market responded.
Yeah. So new is good, but it needs to have that substance behind it. We can't just chase any shiny new object that comes along.
Exactly. And that's actually where it gets interesting, because O'Neill talks about what he calls the great paradox. Often the stocks that seem riskiest, the unknowns, those are the ones that see the biggest explosions in value.
Okay, you're telling me to embrace the unknown here?
Mm-hmm.
I'm starting to sweat a little bit.
Well, think of a company like Syntex Corp back in the 60s, tiny pharma company, right? They came out with this groundbreaking new drug, and bam, their stock took off like a rocket.
Interesting.
This goes against that whole, stick with the big established names advice.
Yeah. Okay, I'm starting to see the light here. So we've got charts, we've got earnings, the power of new. What about those big institutions? Do their moves matter? Should we be paying attention to what they're doing?
Oh, massively. When you see institutions like mutual funds piling into a stock, it's a form of validation. These guys have armies of analysts, so if they're betting big, it's worth paying attention. Plus, it adds liquidity. Easier to buy and sell without those big price swings.
So we should kind of piggyback off their research a little bit.
To a degree, yeah. But remember, even they get it wrong.
Oh, yeah.
O'Neill tells this great story about how his firm recommended selling Xerox back in '74. Everybody loves Xerox, all the big institutions.
Oh.
Well, Xerox tanked. Moral of the story, independent thinking is key. Don't just follow the herd blindly. Even if it's a herd of Wall Street giants, do your own homework.
All right, so no blindly following anyone.
Yeah.
Got it. Now, this next part seems like the foundation of everything. Figuring out which way the market's heading. O'Neill is very clear. You can have the best stock picks in the world, But if you're swimming against the tide.
Yeah, you're going nowhere fast. Trying to time the market perfectly, in at the absolute bottom, out at the absolute peak, that's a fool's game.
So what's the solution then? We can't just sit on the sidelines forever, right?
Well, O'Neill stresses that understanding those overall trends and cycles is key. He uses the 73-74 bear market as an example.
Oh, yeah.
The Dow was down 50%, the average stock was down 70%.
Ouch.
It was a bloodbath.
Brutal.
But it taught investors a very harsh lesson. Fighting a bear market is like wrestling a grizzly bear. You're going to lose.
Okay, so we need to know when to, be aggressive and when to kind of play defense a little bit.
Right.
Speaking of learning from experience, O'Neill is really big on analyzing our mistakes too, right?
Right.
I mean, he even shares this story about how he bought certain teed at the perfect time and then chickened out and sold too early, missed out on tripling his money.
Oh, yeah. It's one thing to pick the right stock. It's another thing to have the discipline and the conviction to hold on.
Even the pros make mistakes.
Absolutely. And O'Neill's point is, be honest about those past screw-ups.
Right.
Figure out why you made those decisions so you don't repeat them.
Okay, so self-awareness and continuous improvement.
Got it.
Now, can we talk about this can slim thing? I feel like that's O'Neill's, secret code for finding winning stocks.
It's not really a secret. I mean, it's all right there in the book, but it is powerful.
Yeah.
Think of it as a checklist. 7 key factors that show up again and again in those biggest winners.
All right, lay it on me. What does can slim stand for?
Right, so C is for current quarterly earnings. You want to see that robust growth, not just a measly little uptick. A is for annual earnings increases. Consistent growth over several years, that's a sign of a company with real staying power.
So a solid track record, not just a flash in the pan.
Exactly. Then you have N, and this is a big one, new products, new management, new highs.
Okay.
Innovation is key. A company that's stuck in its ways is very unlikely to be a market leader. Think of it like this. If a company isn't adapting, if they're not creating, are they really growing?
All right, so we're looking for the companies that are really pushing boundaries.
Exactly. Then we have S, which is for supply and demand. And that basically boils down to watching the trading volume. You see high volume on a price increase. That often means the institutions are jumping in, and that's adding fuel to the fire.
They're putting their money where their mouth is.
Exactly.
Okay, so we've got strong earnings, innovation, institutional backing. What about the L?
L stands for leader or laggard. You want to invest in companies that are outperforming their peers, the ones that are leading the pack.
Oh, I like that. It's like a horse race.
Yeah.
You're betting on the thoroughbred, not the donkey.
Exactly.
All right, I'm going to guess institutional sponsorship, which we've already touched on.
You got it.
Okay.
And that brings us to M, market direction. And we've talked about how crucial it is to understand the overall trends of the market. Even the best stocks can get crushed in a bear market.
Yeah.
Right.
So Can Slim gives us this roadmap, but it's not just about picking the stocks, right?
Right.
We also have to talk about limiting our losses. What about these stop loss orders? O'Neill is a big fan of those.
Well, huge. He's adamant about them. Think of it like insurance. A small premium you pay to protect yourself from a potentially catastrophic loss.
Right.
He recommends setting it around 7% or 8% below your buy price. That way you give the stock a little bit of breathing room, but you're also out before things get really ugly.
So it's about accepting that not every trade is going to be a winner and being okay with taking a small loss to avoid a big one.
Exactly. Managing risk is as important as picking winners. And on that note, he also talks about the importance of holding on to those winning stocks. Let them run, don't get scared, and sell too soon.
Oh yeah, no more second guessing, no more selling as soon as I see a little bit of profit.
Got it.
So we've covered a lot of ground here. Chart reading, earnings, institutional ownership, market direction, this whole Can Slim framework, even managing risk. Where do we go from here? What's next on our deep dive?
Well, I think it's time to put all of this into practice. Let's take a look at some real-world examples of Can Slim in action. I think you'll be surprised by how these principles can lead to some incredible opportunities.
Sounds good to me. Let's do it.
All right, are you ready for a real-life Can Slim success story?
Hit me with it. I'm ready to see this framework in action.
Let's talk about Pick and Save. Now, this discount retailer, they were all about giving people what they needed at crazy low prices.
Okay.
And their stock, it went up over tenfold in 7.5 years.
Tenfold. Okay, now you have my attention. How did they nail the Can Slim formula?
Well, first off, their earnings were like a well-oiled machine, consistently strong, quarter after quarter, year after year.
Okay.
CNA checked off right there.
They had the earnings growth, but did they have that N factor, the new factor?
Oh, absolutely. They were constantly innovating, expanding their product lines, finding ways to be more efficient.
Yeah.
They weren't afraid to try new things, and it clearly paid off.
So they were innovating and growing their earnings.
Yeah.
What about the S for supply and demand? Were institutions buying in?
Big time. In fact, O'Neill's own firm, they bought Pick and Save stock on 285 different days over that period.
Wow.
I mean, they were clearly confident in this company's future, and that kind of buying spree, that pushes the price up.
Yeah, absolutely.
Yeah.
So it sounds like they were really checking all the boxes. Were they a leader then? Were they outperforming their competition?
Oh, they were the Usain Bolt of discount retail. I mean, their stock, it just left the competition in the dust. And of course, they had the market direction working in their favor too. A positive market environment can really make a huge difference.
Right. So they had all the pieces in place, and this Pick and Save story. It's a prime example of what can happen when a company really aligns with all those Can Slim principles. But there's another lesson here too, right?
Oh yeah.
Patience. O'Neill held on to that stock for 7.5 years.
That's right.
He rode those waves and he let that growth story play out.
He wasn't, jumping in and out trying to time every little wiggle. He had a long-term vision.
I think that's where a lot of us stumble.
Yeah.
Right? We see a bit of profit, we're tempted to hit that sell button. But this really shows you those real rewards often come to those who can hold on for the long haul.
That's right. You got to have that long-term perspective.
Okay, so Pick and Save shows us what to do. Let's kind of flip the script now. Let's look at some of those common mistakes that O'Neill warns us about. And one that really stuck with me was this idea of buying on the way down.
Oh yeah.
It seems kind of counterintuitive, but it's a trap that a lot of investors fall into.
It's like trying to catch a falling knife.
Yeah.
You see a stock plummeting and you think, oh, bargain. But what often happens, it keeps plummeting and you end up losing even more. Remember all those cautionary tales we talked about? Xerox, Dome Petroleum, Lucent Technologies, Cisco Systems.
Yeah.
All those stocks looked cheap after big drops, but they just kept falling.
So how do we avoid that?
Yeah.
How do we tell if a falling stock is a true bargain or just a big flashing warning sign?
Well, O'Neill really stresses that you've got to look beyond the price.
Okay.
Is the business itself struggling? Are earnings tanking? Are institutions bailing out? These are all huge red flags. A low price doesn't mean much if the fundamentals are crumbling.
Right. So it's about understanding the story behind the numbers. What about this idea of averaging down, buying more of a stock as it falls, kind of trying to lower your average cost? Does that ever make sense?
Well, it can be tempting, to try and fix a bad investment, but it can be a recipe for disaster. You're essentially throwing good money after bad.
Right.
If a stock is falling for legitimate reasons, buying more just increases your risk. Plus, there's a psychological factor there. It's hard to admit we're wrong and cut our losses.
That sunk cost fallacy, right? We get emotionally attached. We don't want to admit defeat.
Exactly. And O'Neill's point is, be willing to walk away, even if it stings a little bit. Don't let pride keep you clinging to a sinking ship.
Okay, so no catching falling knives and no throwing good money after bad. Now, what about this idea of just kind of ignoring the general market? Just focusing on picking good companies and not worrying too much about what the overall market is doing.
That's a dangerous game. O'Neill compares it to rowing a boat against a strong current. You might be putting in all the effort, but you're still going backwards.
So even if you've picked great stocks, if the overall market is heading south, you can still get dragged down.
Absolutely. He's not saying you have to become a master market timer, but understanding the general trend, it's essential. Trying to fight a bear market is a recipe for frustration and losses.
Okay, point taken. Ride the waves, don't fight them. What about this idea of chasing hot IPOs? Everyone wants to get in early on the next big thing, but what's the downside there?
Well, the hype often inflates the initial price. And once that hype fades, the stock can plummet. He uses Google as an example. Went public in 2004, huge buzz. The price just shot up, but then it corrected sharply.
So how do we avoid getting caught up in all that IPO frenzy?
Patience.
Okay.
He recommends waiting for the stock to settle down after its initial run. Let the hype cool off, let the company's true value emerge.
Okay.
Google actually presented some great buying opportunities after its IPO, but only once the dust settled.
So it's not about avoiding IPOs completely. It's about, approaching them with a level head, with a bit of patience.
Exactly. No FOMO allowed.
All right, no FOMO. Got it.
Yeah.
What about not taking profits? We get attached to our winners. We think they'll go up forever, but there comes a point
Where it makes sense to cash in some of those chips.
Exactly. So when is that point?
Well, O'Neill suggests using both your fundamentals and technical analysis.
Okay.
Ask yourself, has the company's growth story changed? Has the stock become overvalued? Are there signs on the charts that the party's ending?
Right. So it's about being disciplined, not greedy.
Exactly.
Taking profits when it makes sense, even if you're still bullish on the company long term.
Couldn't have said it better myself.
Now, perhaps the most important mistake to avoid, and often the toughest one to stomach, is not cutting your losses.
Oh, absolutely. That's a killer. We hold on, hoping for a turnaround, but a lot of times that just digs the hole deeper. Remember that 7-8% stop loss we talked about?
Right.
That's your safety net. It's there for a reason.
It's like ripping off a Band-Aid, though, isn't it? Sometimes it just hurts.
It can feel that way. But remember, cutting your losses quickly, that frees up your capital to invest in new opportunities.
Right.
He compares it to an insurance policy. You're paying a small premium to protect yourself from a much bigger loss down the road.
Okay. Yeah, I'm starting to see the bigger picture here. It's not just about, picking winners. It's about, managing risk, cutting losses, avoiding those pitfalls that can really sabotage our returns.
Now you're getting it. But of course, picking those winners is still important.
Right.
And that's where O'Neill's focus on institutional investors comes in.
Right.
He calls them the smart money for a reason.
Okay.
They have the resources and the expertise to really sniff out those promising companies.
So we should be following the smart money, but, not blindly.
Exactly.
Yeah.
Don't just blindly follow anyone.
Okay.
Do your homework. Look for stocks with growing institutional ownership, mutual funds, pension funds, all those big players. But don't stop there. Check their track records.
Right.
Are they actually beating the market?
So it's like piggybacking on their expertise, but also making sure they actually know what they're doing.
Exactly. It's another layer of validation. He also talks about management ownership.
Okay.
When the people running the show have skin in the game, their interests are aligned with ours. They're not just employees, they're owners. They're invested in the company's success, literally.
Yeah. Makes sense. Now let's talk about something that I know it gets a lot of hype, and that is stock splits. A lot of times people see that as a good thing.
Right.
What does O'Neill have to say about stock splits?
He actually has a bit of a contrarian view on stock splits.
Okay.
He's particularly wary of splits that happen, near the end of a bull market or the start of a bear market.
Right.
He sees those as a potential red flag.
Why would a stock split be a bad thing?
Well, he believes that stock splits often signal overvaluation.
Okay.
Savvy investors might be using that hype around the split to take profits. It's a lot easier to sell when the price is higher before the split, and then after the split, the price is lower and there are more shares floating around.
So it's almost like it's a sign that the smart money is starting to cash out.
Precisely. Big holders, the ones that own tons and tons of shares, they don't want to flood the market with all those shares after the split.
Yeah.
That can drive the price down. So a stock split isn't inherently bad. It's all about the timing and the context.
Got it. So pay attention to the bigger picture. Now let's get back to this idea of the power of new. O'Neill is really a big advocate for embracing new companies, new products, new management, new highs. He sees this as the engine of growth.
He's spot on. He encourages us to look at new companies, especially those that have strong earnings and sales growth, even if they're in industries that we might not be familiar with.
Right. So don't be afraid of the unfamiliar. Just make sure that there's, solid fundamentals there.
Exactly. Don't just judge a book by its cover.
Mm-hmm.
Think about companies like Home Depot and Microsoft back in the day.
Right.
They were relative newcomers, but they had that entrepreneurial spirit, that drive to innovate. And look what happened. They absolutely exploded in value.
Yeah. So new can be good, but only if it's, backed up by that substance.
Yeah.
And what about patience? Do we need to wait a while for those new companies to kind of, prove themselves?
Sometimes, yes. In fact, O'Neill actually points to a specific chart pattern that he calls the ascending base.
Okay.
He says it often precedes big moves in new companies.
What is an ascending base?
Well, it's a chart pattern where the stock forms a series of higher lows and higher highs, like a staircase going up.
Okay.
And this usually happens during a market correction. The overall market's down, but that particular stock, it's holding up well.
So it's a sign of strength, even in a weak market.
Exactly.
Right. Interesting.
Boeing in 54, Redman Industries in 68, America Online in 99, they all formed ascending bases before going on massive runs.
Okay.
So keep an eye out for that pattern, especially in those newer companies, the ones that are showing some resilience when the market gets shaky.
All right. Ascending base.
Yeah.
Add it to my watch list. Now back to institutional sponsorship. We talked about that earlier. O'Neill really believes that those stocks with strong institutional backing tend to perform better in the long run.
Yeah.
But we've already touched on that. Is there more to it?
Well, it's worth emphasizing, institutions, they have the resources, they have the expertise to really sniff out those promising companies.
Right.
And their buying power. I mean, that can really push a stock's price up. It can create a lot of momentum.
So how can we tell if a stock has strong institutional support?
Well, look for a growing number of institutional owners. You'll find that listed in the company's filings. Those mutual funds, pension funds, all the big players we talked about. But don't just look at quantity, look at quality.
Okay.
Are those institutions known for beating the market?
So it's about finding the stocks that are attracting the attention of the best investors out there.
Exactly. Think of it as a stamp of approval.
Yeah. Now, what about liquidity? How does institutional ownership affect liquidity?
Well, it makes the stock easier to buy and sell, without those huge price swings. And that's really crucial, especially if you need to get out of a position quickly or if the market takes a sudden nosedive.
Right.
You don't want to be stuck with a stock that you can't unload.
So liquidity is almost like having an escape route just in case.
Exactly. And institutional ownership is a big factor in that.
Okay.
O'Neill even talks about how the stock market is so much more liquid than real estate.
Right.
Try selling a house quickly when the market crashes. It's not easy.
Yeah, good point. Now let's talk about another really crucial aspect that O'Neill emphasizes, and that is determining market direction.
Yeah.
He argues that, even with the perfect stock picks, if you're wrong about which way the market is heading, that can be fatal to your portfolio.
Yeah, it can be. He's absolutely right. It's like sailing.
Okay.
You can be the best sailor in the world, but if you're sailing against the wind, you're not getting very far.
So how do we figure out which way the wind is blowing? How do we tell if we're in a bull market or a bear market?
Well, O'Neill says you've got to focus on those price and volume actions.
Okay.
Of those major market indices, the Dow Jones, S&P 500, the NASDAQ.
Okay.
He looks for patterns that show who's really in control, the buyers or the sellers.
Can you give us some examples?
Sure. In a bull market, you typically see a series of higher highs and higher lows in those indices, usually with increasing volume.
Okay.
That tells you buyers are stepping in, pushing the market higher. Now, in a bear market, you'll often see the opposite, lower highs and lower lows, sometimes with declining volume. That's a sign that sellers are calling the shots.
Okay, so it's about recognizing those patterns and then adjusting our strategies accordingly, right?
Exactly. You don't want to be buying aggressively when the market is heading south. You don't want to be selling your winners when it's rallying.
Right.
But O'Neill also warns about false signals. A down day or two doesn't mean the bull market is over, and a couple of up days doesn't mean the bear market's gone.
So how do we avoid getting, whipsawed by all these short-term fluctuations?
You got to look for confirmation from multiple indicators.
Okay.
Are those indices making new highs or new lows?
Right.
Is volume supporting that price action?
Okay.
Are those leading stocks breaking out or are they breaking down? By putting all those pieces together, you start to get a clearer picture.
So it's not about reacting to every little blip. It's about
Yeah.
understanding those bigger trends, those cycles.
Exactly. Now, O'Neill actually has a specific term for this. He calls it the follow-through day. It's a day where the market rallies strongly on higher volume after a period of decline. He has specific criteria for it.
Okay.
But basically, it's a sign that buyers are back in a big way.
So it's not just any random up day. It's a sign that the tide is turning.
Exactly. Now, on the flip side, there are distribution days where the market drops sharply on high volume. This suggests that institutions are selling, and it can be a warning sign that a correction or bear market is brewing.
So it's almost like the smart money is heading to the exits.
That's right. Recognizing those distribution days can help us adjust our portfolios accordingly, maybe take some profits, raise some cash, just reduce your overall exposure a bit.
Okay, so follow-through days are good. Distribution days are a warning sign.
Got it.
Got it. Now, what about market cycles? O'Neill talks about those too, right?
Oh, he does. He does. Those market cycles typically have 4 phases: accumulation, markup, distribution, and markdown.
Okay.
Knowing where we are in that cycle, that's crucial for making those smart decisions.
So walk us through those phases. What happens in each one?
All right, well, accumulation, that happens after a bear market. The market's kind of bottoming out. The smart investors, they're starting to scoop up those undervalued stocks. It's a good time to start building your portfolio.
So it's like bargain hunting season.
Exactly. Then we have markup. This is what follows accumulation. The market's trending upwards, leading stocks are breaking out. It's a time to be buying those stocks that are showing strength and momentum.
Okay.
Then we have distribution, and this typically happens after a long bull market. The market's kind of topping out, those leading stocks are starting to weaken, and this is a good time to, take some profits, raise some cash, maybe reduce your exposure a bit.
So take some chips off the table before things get too risky.
Exactly.
Okay. And lastly,
Markdown.
okay.
This is essentially your bear market. Most stocks are falling. It's a time to be really selective, focus on preserving capital. Don't try and make those big risky bets during a markdown.
So hunker down, weather the storm.
Exactly. The key takeaway here is by understanding where we are in the market cycle, we can make those smarter decisions about when to be aggressive and when to be cautious.
This is all making a lot of sense. And O'Neill really provides some great tools, some great techniques for figuring out that market direction and identifying those different phases. Now, we've talked a lot about picking stocks, understanding market trends, managing risk. But something tells me there's more to it than just the technical side.
Oh, absolutely. O'Neill really emphasizes having a clear investment plan. Set those realistic expectations, stay focused on your long-term goals. And of course, continuous learning is key.
Oh, yeah.
The market is always evolving, so we need to evolve with it.
Okay, so stay informed, adapt, and keep learning. Sounds like a solid plan to me. Now, what about chart reading? I know we touched on it earlier, but I kind of want to go deeper on this.
Sure.
O'Neill really believes in the power of charts, right?
Oh, he does. He sees them as a visual representation of supply and demand in action. Charts tell a story. And by learning to read them, we can really get those valuable insights into how a stock is likely to behave.
So we're not just looking at, lines on a graph. We're looking for patterns. We're looking for signals.
Exactly. And O'Neill, he's identified a number of those classic chart patterns that often precede big price moves. One of the most famous ones is the cup with handle pattern.
Okay, I've heard of that one.
Yeah.
What does it look like, and what does it tell us?
Well, imagine a chart that literally looks like a cup with a handle.
Okay.
Now, the cup represents a period of consolidation. The stock is kind of taking a breather after a big run up. The handle, that's a final pullback before the stock is ready to break out to those new highs.
So it's almost like the stock is kind of gathering energy before it takes off.
That's a great way to put it. Now, O'Neill, he has specific criteria for what makes a cup with handle valid.
Okay.
It's not just any cup and handle. The depth of the cup, the length of the handle, the volume patterns, that all matters.
Okay.
But when you see a proper cup with handle, it can be a very powerful signal.
Okay. So cup with handle, that's on my radar.
Right.
Are there other chart patterns that we should be aware of?
Oh, definitely. The double bottom base, the flat base, the Sasso base, those are all worth learning. They all signal potential buying opportunities. And remember, volume is crucial too.
Okay.
A breakout on high volume is much more reliable than a breakout on low volume.
So it's like the volume is confirming the price action.
Exactly. And volume can also help us identify those accumulation and distribution phases that we talked about earlier.
Right, right. Accumulations when the institutions are buying, distributions when they're selling. So volume can kind of tell us which way the smart money is leaning.
Exactly. It's like having an insider's view.
Okay. Now back to risk management.
Okay.
We talked about stop loss orders before, but can you just remind us why they're so important?
Oh, they're essential for limiting those potential losses. They act as a safety net. They protect you from those catastrophic drops that can just wipe out your hard-earned gains.
Right.
Like an insurance policy on your investments.
Okay. All right, so stop loss, that's set. Now, what about letting your winners run? How do we know when to sell? When is the right time to take profits?
That's the million-dollar question. O'Neill says don't be tempted to sell too early just because you've made a quick profit. Let the market tell you when it's time to sell. He suggests using a combination of both your fundamentals and your technical analysis.
So it's about balancing those two approaches,
Exactly.
not just relying on one or the other.
Ask yourself, has the company's growth story changed? Has the stock become overvalued? Are there signs on those charts that the momentum is fading?
Right. So it's about being patient and letting those profits grow, but also being vigilant and knowing when it's time to take profits off the table.
You're thinking like an O'Neill disciple now.
All right. So far we've covered how to pick those winning stocks, how to read the market, how to manage risk. What's next on our deep dive?
Well, let's talk about specific industries and sectors. The ones that O'Neill believes have that biggest growth potential. He knows that certain industries are just naturally more innovative, more dynamic than others.
Right.
And those are the ones we want to be focusing on.
So which industries does he favor?
Well, he's been particularly bullish on technology, and for obvious reasons, right?
Yeah.
It's constantly evolving, it's always pushing boundaries, and it's given birth to some of the biggest companies in the world.
We've seen that firsthand. I mean, Apple, Microsoft, Amazon, Google, prime examples.
Exactly. But technology isn't the only game in town.
Okay.
He's also very keen on healthcare.
Okay.
Given our aging population and, the growing demand for new treatments and new technologies.
So companies in biotech, pharmaceuticals, medical devices, those are worth a look.
Absolutely. He also highlights the consumer discretionary sector,
Okay.
which includes all those companies that benefit from rising affluence. As people get wealthier, they spend more on travel, leisure, entertainment, luxury goods.
Right. So economic growth often translates into, more spending in those areas.
Exactly.
Okay. I'm starting to see the types of industries that O'Neill really likes. Those that are kind of at the forefront of innovation and those that benefit from rising prosperity.
That's right. But identifying those promising industries, that's just the first step.
Okay.
Now we need to talk about something that often gets overlooked, and that is managing our emotions.
Oh yeah, the psychological side of investing.
That's right.
And I have a feeling that's where a lot of us trip up.
You're not wrong. O'Neill recognizes that our emotions can really lead us astray.
Right.
Cause us to make impulsive decisions that we later regret. Fear and greed. Those are the two big culprits.
Oh yeah, fear makes us sell at the worst possible time. Greed makes us buy at inflated prices.
Exactly. So how do we control those emotions? Well, O'Neill suggests having a well-defined plan. Set those realistic expectations. Focus on the long term. It's about being rational. It's about being disciplined, even when the market is going crazy around you.
Right. So it's like having a set of rules to follow so that we don't, let our emotions take over.
Exactly. Stick to the plan. Don't let those emotions cloud your judgment. And remember, selling a stock doesn't mean you were wrong to buy it in the first place.
Okay.
Sometimes circumstances change.
Okay.
And it's simply time to move on.
So don't fall in love with your stocks.
Yeah.
What other pitfalls should we watch out for?
Another common one is getting caught up in the hype.
Oh yeah.
We hear about a hot new industry, a company that's supposedly going to change the world, and we just rush in without doing our due diligence.
Right. It's easy to get swept up in all that excitement, especially when everybody's talking about a particular stock.
It is. But remember, hype is not a substitute for solid fundamentals. Before you invest in any company, take the time to understand their business, their financials, their competitive landscape. Don't just buy the story, verify it.
Okay, so do your homework. Don't just follow the crowd blindly. What other traps should we be on the lookout for?
Well, another one is ignoring the bigger picture. We get so focused on individual stocks that we forget about the overall market environment. But remember, a rising tide lifts all boats, and a falling tide can sink even the strongest ships.
Right. But we talked about this earlier, understanding those market cycles, adjusting our strategies accordingly.
Exactly.
Don't be afraid to take profits when the market is topping out. Don't be afraid to raise cash and sit on the sidelines during a bear market.
That's right. Preserving capital is just as important as growing it.
Okay, so keep an eye on the big picture. Don't get tunnel vision on individual stocks. What other words of wisdom does O'Neill offer?
Well, he emphasizes the importance of diversification. Don't put all your eggs in one basket.
Right.
Spread your investments across different industries, different sectors, different asset classes. That way, if one area of the market takes a hit, you're not completely wiped out.
Right. So diversification, that's a key risk management tool.
Absolutely. And remember, diversification doesn't just mean owning a lot of different stocks.
Okay.
It also means owning different types of assets. Bonds, real estate, commodities.
So build a portfolio that can, weather those different market conditions.
Exactly. Now, another pitfall that's, particularly relevant today is this overwhelming amount of information that's available to us. We're constantly bombarded with news, opinions, data. It can be tough to filter. It can be tough to filter out all that noise and just focus on what's really important.
Yeah. It's information overload. How do we avoid getting paralyzed by all this analysis?
Well, O'Neill encourages us to develop our own investment philosophy. Stick to your principles. Don't get swayed by every headline or every talking head you see on TV.
Right.
Trust your research.
Okay, yeah.
Trust your judgment. Trust your process.
So develop a strategy, have a plan, stick to it, and don't let the noise kind of distract you.
Exactly. Now, one final pitfall to watch out for is this tendency to chase performance. We see a stock or a mutual fund that's done incredibly well in the past,
Yeah.
and we assume it's going to continue to perform well in the future. But you know what they say?
Past performance is not indicative of future results.
Exactly. Just because something has gone up in the past doesn't mean it's going to keep going up. In fact, chasing performance can often lead to buying at the top and selling at the bottom. Not exactly a recipe for success.
Right. So don't get caught up in the rear view mirror. Focus on the road ahead.
That's right. And that brings us to perhaps the most important takeaway from O'Neill's book. And that is, investing is a journey, not a destination.
I love that. It's about continuous learning. Adapting, evolving as the market changes.
Exactly. There's no magic formula. There's no guaranteed path to riches. But with the right mindset, the right tools, and a commitment to continuous improvement, we can all become successful investors.
Well, this has been an incredible deep dive into William O'Neill's How to Make Money in Stocks. We've covered so much ground, from the technical aspects of chart reading and fundamental analysis to the psychological challenges of, managing our emotions, avoiding common pitfalls. I feel like I've learned a ton.
It's been a great discussion. And it's not just about memorizing a set of rules.
Right.
It's about understanding those principles and applying them to our own unique investment style and our own goals.
Exactly. It's about taking what we've learned, putting it into practice and becoming the best investors we can be.
That's right. And never forget, the journey itself is part of the reward.
Yeah.
Embrace the challenges, learn from your mistakes, never stop striving to improve those skills.
Well said. Now, as we wrap up this deep dive, we'd like to leave you with one final thought. Based on what you've learned today, what one stock will you research further? Happy investing, everyone.